In this video, I'm going to go through the only two funds that you will ever need when it comes to long-term investing. You potentially only need one of them for a long period of time as well, so you make your investing life so much easier. My name is Ryan, welcome back to Making Money Simple. I try and make regular investing content here, following my investing journey and what I learn. And this video is going to be something I've learned a while ago and I also implement to some extent, but I've not talked about specifically on this channel before. If you like the video, drop a like. Of course, subscribe for more investing content, but let's get straight into it. So the two funds that you need, what are they? A global stock fund and a global bond fund. Now I'm talking here just about the stock market. Of course there are other asset classes, but realistically, even in terms of other asset classes, property, crypto, commodities, these two probably are still the most accessible and powerful investments to help you achieve financial freedom, or at least get you started in the wealth building process and to help you build wealth over your lifetime, over the next few decades. If you've been following me, you know I'm a huge fan of the global investment approach, and I think ultimately by just using a single fund, or in this case two funds, it makes your investment portfolio so much easier to manage, so much lower stress, so much less maintenance, because you've only got 1 to 2 funds rather than having 5 funds, 10 different stocks, 15 different ETFs. And generally speaking, taking the global approach not only is lower risk because you're globally diversified across the whole world, but also generally gives higher returns over the long term. Why? That is because people trying to pick individual stocks or individual countries or individual sectors or niches often underperform a simple broad market index fund or ETF. And when it comes to global index funds and ETFs, that's the most broad market you can get. First of all, let's look at the global stock fund, and the fund here, of course, is the FTSE Global All Cap. I will give another couple of recommendations shortly, or well, it's not financial advice, but a couple of pointers so you can go and do your own research. But the FTSE Global All Cap is a global index fund. It is over 7,000 stocks all around the world. It's globally diversified, and that is the only stock fund that you need. You could potentially sub that out for something like a life strategy fund or lifestyle fund, or a target date retirement fund, but generally speaking, those things aren't necessarily weighted correctly and could be higher fee. So using the FTSE Global All Cap over the long term, you can't really go wrong. A similar ETF version, if you haven't got the FTSE Global All Cap or the life strategy funds or target date retirement funds available on your platform, so I'm talking here about Vanguard and what's on their platform, then you can look at VWRL or VWRP. That's essentially the FTSE All World. So if you just search on your platform FTSE All World, that's another very diversified option. The only difference to the All Cap is that it doesn't include small companies, it includes only large and medium companies, but ultimately the returns have been pretty much identical over the years and years. So yeah, the FTSE Global All Cap or the FTSE All World is the only global funds that you need. A question people ask me, do you need both? I mean, not really. If you invest in both, you're gonna have a lot of overlap, so you only need one. And I personally use the FTSE Global All Cap because that's available on Vanguard. That's my only investment in my stocks and shares ISA and my private pension. And then on other platforms where the FTSE Global All Cap isn't available, like Trading 212 and Free Trade, that's why I then use the FTSE All World, because that is usually available, because generally speaking, ETFs are normally on more platforms than index funds. So that covers stocks. Now number 2, let's talk about bonds. And once again, I'm gonna give you an index fund option and an ETF option. So the index fund option is the Global Bond Index Fund on Vanguard. It is over 13,000 bonds, which is mental, for a very low ongoing charge of 0.15%. I'll get onto if you need bonds or when you need bonds shortly. But this bond fund has a range of different credit qualities, from most of them are AAA though, so they're relatively safe bonds, but all the way down to even a couple of % of bonds that aren't rated. They're diversified not just across credit ratings, but also across different maturity years, from under 1 year to more than 25 years, distributed by different issuers, by different countries. It's essentially a global bond fund that is as diversified as it gets, and there's 13,000 different bonds in here. An ETF version I'll show up on the screen now is the Global Aggregate Bond ETF, and essentially it's a similar thing. There's slightly less bonds, only 8,000, so it's not as diversified. The ongoing charge is slightly lower as well at 0.1%, but it aims to do the same thing, just in an ETF form. It's diversified across different bond lengths, bond ratings, bond issuers, different countries, and so on. And now the only 2 funds you need. So for me personally, if I was doing this, I would get the FTSE Global All Cap and the Global Bond Index Fund, both index funds, set up automatic investments in the right allocation that I want, and that's pretty much it. We're going to come on to allocation shortly, but let's talk about, do you need bonds and when you need bonds. So first of all, do you need bonds? I personally am 25 and I have no bonds, and to be honest with you, I don't plan on having bonds for a very long time. Bonds essentially provide a bit of a cushion when things are volatile, and I guess as people get older, they normally allocate more to bonds, or what you'll see is these sort of life strategy target date retirement funds will try and allocate more to bonds as you approach retirement age of 60, 65, so then it smooths out the ride. Generally speaking though, if you're investing for the long term, stocks give a much better return than bonds through the capital gains and dividends. Even if you're, 50, you're going to be investing for maybe 15, 20, 30, 40 years until you die. Stocks are going to outperform bonds over that period, which is why, even though I'm not older yet, I'm in one mind if you actually do need bonds. Stock market portfolios generally outperform a mix of both stock and bond portfolios, but of course it depends on what period you're looking at. But ultimately, do you need bonds? It's personal preference. If you're more risk averse, maybe you have a family, maybe you're older, then it could be good to incorporate some bonds just to smooth out the ride a little bit over the long term. When do you need bonds? It's going to be a similar answer. It sort of depends on how risk averse you are, on your sort of risk tolerance and risk profile, but generally I'd say later on in life, maybe you start getting a family into your 40s, 50s, 60s, that is when you could allocate some to bonds. But no, over the long term, stocks will outperform bonds. In most decades, unless there's a huge stock market crash, the stocks market does normally outperform the bond market. Of course, it's impossible to know what's going to happen going forward, not financial advice, but that's just what the data sort of shows over like the last decades and 100 years. And the most important point really though is ultimately asset allocation. You have 100% of your portfolio and you can allocate that to stocks or bonds. I'm personally, when it comes to the stock market, 100% in stocks. What should you be in bonds? There's a few different rules of thumb you can use. You can minus your age. So if I'm 25, I could put say 75% in stocks and 25% in bonds. But I personally think that's too conservative. If I'm going to be investing now for the next 40 years till retirement age, and hopefully long after that, if I survive into my 70s and 80s, then having 25% of bonds at such a young age, I'm going to miss out on stock market returns over the long term. But the percentage, your asset allocation is going to be the most important thing here. You've got the global bond fund, you've got the global stock fund. Now, all you need to decide is what percentage to allocate to each. As I said, I'm personally 100 stock, 0 bond, but you might, if you're 45 with some kids, maybe you're going to go self-employed in 5 years and you might retire soon, maybe you might put 25% in bonds at that point because that's what you're happy with. It's hard to say an exact science, but it's really personal preference. Of course, if you do use a mix of stocks and bonds, let me know in the comments how you do it. I'm interested to find out more because as I said, me personally, I'm still 100% stocks. A couple of points here to wrap up this video. I hope it's been helpful. Of course, if it has, drop a like. You can switch these funds for ESG funds, supposed to be more environmentally friendly funds. That's debated whether they actually are because some companies in them aren't environmentally friendly. I won't get into that, but you can switch these for ESG funds. And ultimately the bottom line is with this approach, whether it's one stock fund you're using or one bond fund or a combination of both, because they're both global, it's as diversified as you can get. And when it comes to your own personal sort of strategy and situation, if you're going to do this, whatever country you're in, whatever platform you're using, if you can't find these funds I mentioned, these Vanguard funds, what you want to do is you want to find a global fund with the most diversification for the lowest fee and essentially use that. I use Vanguard for my ISA, my SIP, for all of my ETFs and funds, index funds, just because I think they're, I've made videos on them, talk about them a lot. They're safe, reliable, huge asset manager, but you may not have access to them in your country, or you may use a different platform or provider. So what you're looking for is the most diversification for the lowest fee possible. Thank you very much for watching the video. I really appreciate it. I'll be interested in your strategy in the comments below. Do you follow this or something else? Let me know, and I'll see you in the next one.